Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. Last week, markets were marked by heightened volatility, by initial selling, followed by a sharp rebound in equities as expectations for Federal Reserve rate cuts surged. But both the S&P 500 and the NASDAQ Composite still posted overall weekly losses. Technology, particularly AI and semiconductor stocks like NVIDIA, continued to face profit-taking and valuation concerns, driving much of the weakness in major indices. By late week, dovish commentary from the Federal Reserve officials fueled a rally that benefited undervalued sectors such as biotech, retail, and small caps as investor optimism around monetary policy returned. For bonds, U.S. Treasury yields retreated from earlier highs, with the 10-year Treasury finishing near 4.07%, supporting investment-grade and municipal bonds that saw steady inflows and stable returns. While high-yield corporates and senior loans outperformed, the riskier segments felt pressure due to credit risk and moderate outflows. Broadly, fixed income markets responded positively to shifting Fed expectations, but showed caution in the lower quality credit space. So let's hop into our discussion for this week, starting with our key market indicators. And we'll continue our discussion by talking more about the contributors and detractors of the market. Once again, the goal is that we continue to highlight the key drivers of these market indices. So with that, let's hop right in. First, each week we review the Atlanta Fed's seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 4.2% growth as of November 21st, which is higher than the 4.0% that we reported last week. Now we finally have updated unemployment data, and we'll start this week by showing the initial claims data, which ended at 220,000, while continuing claims ended at 1.974 million. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw very slight movement on the upward side on mortgage rates, where the 30-year and the 15-year mortgage rates ended at 6.26% and 5.54% respectively. Next, we'll look at investor sentiment. Now, one measurement of investor sentiment is the bull-to-bear spread. Our latest update shows the bull-to-bear spread ended at negative 10.98%, showing that investors are still feeling pretty bearish with the current market environment. Now, another measurement of investor sentiment is the VIX, or the Volatility Index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price-to-action relationship to the S&P 500. Now, we saw this in real time this past week. I want to highlight that, remember, VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 23.43. However, earlier in the week, we did spike above 26. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 71% probability of a 0.25% decrease and a 29% probability of no cut in December. Now, this is a pretty significant change from last week. Last week, we were seeing these markets showing a 45% probability of a 0.25% decrease in December. Much of this change is due to the dovish outlook that the Fed shared last week, which directly impacted small and mid-cap stocks, which we'll talk about next. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 1.01%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 1.22%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was negative 2.69%. The winner this week goes to mid-cap stocks, or aggressive growth stocks. Now remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, please don't hesitate to connect with one of our advisors today. So with that, let's jump right into our discussion around the contributors and detractors that moved these market indices in the past week. All right, let's talk about the contributors and detractors for market movement in the past week. So on the equity side, we saw technology and AI stocks lead the week's declines as investors pulled back from high valuation names, but momentum reversed midweek after dovish Fed signals encouraged a shift into sectors like biotech and small caps. Sectors with undervalued or stable earnings, including healthcare and select consumer names, benefited most from this rotation. Despite the rally, both the S&P 500 and the Nasdaq Composite ended the week down, reflecting broader market caution. Now on the bond side, we saw treasuries and higher quality debt rallied late in the week as yields fell on renewed rate cut expectations. Investment grade and municipal bonds outperformed riskier segments while high yield bonds and leverage loans saw some pressure from elevated credit concerns. Inflows remained steady for safer bonds, but spreads for lower quality credit widened as volatility persisted. Market movement was thus shaped by macro policy shifts, changing sentiment towards growth stocks, and continued demand for high-quality fixed income amid ongoing economic uncertainty. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Now, on that note, I want to invite you all to a webinar hosted by Cage Rush. He's our CPA and CFO here at Whitaker-Myers Wealth Managers. This will be held on November 24th from 4 p.m. to 5 p.m. Now, as we approach the close of a year marked by significant tax law changes and shifting economic conditions, it's important more than ever to review your options and proactively plan for your tax future. All of this so that you are empowering your finish of 2025 with confidence and setting a strong foundation for the year ahead. So register to attend this webinar by clicking on the link in the description below or by visiting our website. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you so much for watching. We look forward to seeing you next week.